Hello and welcome. This is Startup Street. I'm Ritu Singh, and with me, as always, my colleague Shruti Mishra. Here are the top headlines from the startup space that we're tracking for you today. PayU is selling its global payments organization business for $610 million in an all-cash deal to Rapid, the fintech-as-a-service startup. According to Dutch investor Prosus, the deal will enable its fintech arm to focus on the large payments and fintech opportunity in India.
Byju's has sent a legal notice to founders of Aakash Educational Services following their alleged resistance to complete a share swap that was unconditionally agreed as part of the sale of Aakash. The minority shareholders have declined to swap their equity holding in AESL with the firm's parent, PTI reports.
Fidelity Investments has marked down a conversational messaging unicorn Gupshup's valuation to about $700 million. Fidelity has slashed its fair value to a little over $8 million, and this is the third valuation markdown by Fidelity in Gupshup.
Tech giant Microsoft has appointed Puneet Chandok as corporate vice president of Microsoft India and South Asia. Chandok will assume his operational responsibilities from Anand Maheshwari on September 1st.
Uber's chief financial officer, Nelson Chai, will leave the ride-hailing company in January next year, marking one of the most high-profile departures since the company went public in 2019. A search for his replacement is underway.
Well, those were the headlines we've been tracking for you this evening. On Startup Street now, Clix Capital, a tech-led NBFC, has signed a $20 million loan from Global Climate Partnership Fund, a Luxembourg-based public-private partnership fund that finances renewable energy and energy efficiency projects across several developing and emerging nations. Now, Clix Capital aims that the infusion of sustainable and green funds will further fortify its lending portfolio and solidify its commitment to sustainability. And to elaborate on the road ahead, joining me now is its MD and CEO, Rakesh Kaul. Rakesh, welcome to Startup Street. Now, with a year-on-year surge of 122%, Clix Capital also records 12.06 billion rupees as its highest ever quarterly fundraise, of course, since inception. Now, further, your core book assets under management marked a 43% year-on-year growth, and profitability witnessed 534% increase in quarter one of last fiscal. What has led to this bullish growth, Rakesh?
Thank you. Thank you for firstly inviting me to this show. Grateful for this opportunity. I think Clix is today very, very well positioned to ride on the economy revival that has happened post-COVID. We utilized the period of COVID while a very difficult time. We used it very sensibly in making our operations extremely, extremely digital, re-looking at our strategy and doing a lot of research on imagining which are the sectors that are going to benefit the most once COVID would be over. And we are thankful that the sectors that we chose to put all our investments into are the ones that have seen a huge amount of demand, have seen a huge amount of government policy support, and we are absolutely at the right place at the right time. So I think that's the reason why all the numbers that you just spoke about have done well.
All right. So like you mentioned, Clix Capital provides the much-needed credit support to India's SMEs in healthcare, education and the other sectors. And with this funding, you're now looking at sustainable projects that help to mitigate climate change. Rakesh, can you elaborate on the kind of startups that you're looking for and what the ticket size of investments be?
So we are always on the lookout for investing in startups and MSMEs that have a sound business model. So the companies that we are now going to focus a lot more will be companies that are either focused on supplying to EV value chains, companies that are focused on waste management, companies that are supplying to, let's say, solar panel manufacturers. So all the sectors which are classified under the green energy are the sectors that we are now going to double down on with this investment that we have found from the Impact Fund.
Okay, so you said you're looking to double down, but have you already invested in some companies? And if not, how soon do you plan to roll out your investments?
We did make a small start. The reporting for this funding is not easy, but we did make a start before we got this large fund. And now that we have done the pilots and we have tested, I think we are now in a very good position to ensure that these funds are deployed in the next 6 months.
All right, in the next 6 months. But how many startups? Is there a target for the year?
Yes, there is. We are aiming to look at least 100 startups in each of the sectors that we spoke.
Okay.
And of course, depending on how the funds flow in, we are always open to more business.
All right, so 100 startups, that's a bold target, Rakesh. Moving on, Clix Capital offers a diverse range of lending solutions, including secured and unsecured MSME loans. You've got healthcare equipment finance, mortgage finance, and then K-12 school financing. Any new offerings that you can talk to us about that are in the pipeline?
I think one of our strategies is to stay focused on the segments that we have chosen. And these segments in itself offer such a huge opportunity. And the $300 billion credit gap that the MSME sector has in India, there's enough roadmap for us to stay focused on the sectors that we have chosen. But within these sectors, we will go deeper and we'll go a little wider. But we will stay as a strategy for the next couple of years in these segments that we have chosen. But we will continue to look for needs of these segments, and wherever we can supply and solve for those problem statements for these MSMEs and these sectors, we are always open to innovate and bring out new products.
Okay, so talk to me about the kind of targets that you've set for yourself in terms of revenue and expansion going forward.
So given the size of the financial services market, I think we are still a small company. So for the next 2 to 3 years, growing at about 45 to 50% won't be a challenge. But post that, we want to have a sustainable business with a very, very sharp eye on our portfolio quality. So we believe that a good, healthy growth of about 25 to 28% beyond the next 2 to 3 years is something that we are aiming for.
Okay. Now, Rakesh, let's talk about the sector. According to multiple reports, India requires a budget of over $10 trillion to become a net zero emission nation by 2070. And however, only 1/4 of its green finance requirements are being met currently. So if you could tell us what are the big challenges and the key imperatives to drive green investments in the country?
Imperatives are very clear.
Okay.
Because, India, unfortunately, is one of the most vulnerable economies in the world to climate change. We have a very large coastline. We have a very large share of our fuel needs that are still fossil-based. And we have a very large population of our country which is dependent on agriculture, which is in turn dependent on the seasonal monsoons. So all of this puts us at a grave risk. So the NDCs that we have chosen to follow and the targets that we have taken, it is imperative that there is huge policy support and there is a huge amount of industry adoption in making this possible. Otherwise, we risk losing almost 3% of our annual GDP to damages resulting in climate change. And I think very clearly the challenges right now are the basic knowledge about this change, the technology, the long gestation period of some of these initiatives that are prohibitive in cost. So a lot of these challenges and starting basically from knowledge is where the gap is.
All right, Rakesh, I'll have to wrap up our conversation. Keep powering eco-conscious entrepreneurs and wishing you the very best in creating a greener future. Many thanks for joining us on the show today.
My pleasure. Thank you so much for inviting us. Thank you.
All right. Now, the e-commerce industry is expected to generate almost 7 lakh gig jobs in the second half of 2023 as companies gear up to fulfill consumer demand during the festive season sales. Now, this is as per the findings of a study conducted by e-Teamlease services, which says that this year's festive hiring is anticipated to see a 25% increase in gig jobs compared to the same period last year. Joining me now to talk about the findings of this report is Bala Subramaniam A., the Vice President and Business Head at e-Teamlease Services. Mr. Bala Subramaniam, thank you very much for your time here on CNBC-TV18. Let's start with the key findings then. 7 lakh gig jobs in the second half alone, 25% more than last year. What's driving this kind of a growth?
Firstly, thank you so very much for hosting me on this show. So yes, to begin with the approach of the festive season, e-commerce companies operating in India are gearing up to fulfill increased consumer demands during this annual shopping frenzy, so to speak. This surge in shopping activity is projected to generate almost 7 lakh incremental gig jobs just for the second half of 2023. Now, with July opening up the market with shopping festivals by various e-commerce players, the sector currently has around 2 lakh open positions. Again, this is just incremental for temp workers, primarily in the last mile delivery and warehouse operation space. Now, this is expected to grow to about 7 lakh over the course of these 6 months, that is from July until about December of 2022. Now, what exactly is driving this? There are various factors. I'd like to firstly focus on how exactly e-commerce as an industry is growing because of 5 factors: digitalization, increased mobile internet penetration. Hundreds of millions of people in India have directly leapfrogged using internet on smartphones. These are people who may never have used a landline phone in their life, may never have even used a normal feature phone for that matter. Second feature is increased consumption. There is a growing aspirational middle class as well. Thirdly, there is increased affordability of online products. Fourthly, there is government support. And fifthly, there is increased social media's reach as well, and e-commerce companies are riding on this as well. So all of these factors are contributing to the increase in demand, which in turn is leading to an increase in supply of gig workers as well.
Sure, Balasubramanian, what you're outlining actually has been the India e-commerce growth story for the last several years, but very specific to the second half of this year, given the macro challenges and the higher inflation. Is there anything else that would really account for this kind of an increase?
I think the incremental growth this year compared to last year is actually driven by what's been happening in the last 18 months, in fact, because in H1 of last year, really, the war broke out. And because of that, supply chains world over were choked. Inflation was through the roofs. And demand was actually pretty muted in the second half of last year. And because of input costs going up, a lot of manufacturers were in a situation where they were forced to pass on several tranches of price increases to the consumers for their own sustenance. Yeah. And because of this, especially in rural areas, demand was extremely muted. So in part, this significant increase in demand is also owing to the base effect, specifically in rural areas, which is why the proportionate contribution of manpower demand in tier 2 and tier 3 cities this time is more than it is even for metro and tier 1 locations. So that, I think, is a significant factor behind what's driving the demand this time around.
So, this 2.35 crore figure as the expected increase in the gig workforce in the next few years, how much of that is going to come in the rural areas versus the urban areas?
We expect that in tier 2 and tier 3 locations, it's really going to outpace metro and tier 1. At this point in time, it's neck and neck with tier 2, tier 3 locations being slightly less than 50%. But by the end of 2030, we expect it to flip. It could be 60% in favor of tier 2, tier 3 locations, or maybe even a bit more than that.
Well, that's the Bharat opportunity we keep talking about here at CNBC-TV18 as well. What about the salaries, though? Given the demand is going up, are salaries also keeping pace with the inflation, with the demand? What's the trend been there?
It's a little mixed, though. I think in the lowest income group, that is below 20,000 rupees per month, that is, the salary increase has not been all that great. But then if you look at the next segment in the pyramid, which is people who are drawing about 20 to 40K, there the average increase has been in the range of about 20 to 25%. Okay. So there, this is indicative of, a large middle class for the future by around 2030 or so.
Okay. That's interesting. So the higher segment's actually seeing a faster growth as well. But, your report also says the surge in temporary workforce hiring is not limited to the e-commerce sector, right? What are the other sectors where demand is expected to come for the gig workforce?
There is going to be a direct spillover into retail, logistics, even BFSI for that matter, and also in healthcare and education as well. But largely, it's a phenomenon that you would see primarily in e-commerce, logistics, and retail.
E-commerce, logistics and retail are expected to drive the hiring this year. But before we close, Balasubramanian, quick word. What would be the proportion of the gig workforce versus the permanent employees, especially the e-commerce companies? Is it going to heavily change in favor of gig workers, given how these trends are shaping up, or is that unlikely to be the case?
It's already skewed significantly in favor of gig workers. I mean, it's disproportionate at this point in time. Over 95% of the workers in the e-commerce space already are in the gig model. And this is not just frontline workers. Even among people who are earning higher salaries, there are a lot of people in the technology space who are hired for 3-6 month projects as well. And this is definitely going to remain the same in the future as well. We don't really see that changing in any way. It might get even more skewed, if anything.
Any numbers you could share with us in that sense? I mean, what proportion would be the gig workers? Significantly skewed,
like I said,
know
it's already significantly skewed, about 90-95%. I don't really see that changing much, though.
All right, so 90 to 93%. All right, Balasubramanian, thank you very much for highlighting those trends for us. It was a pleasure speaking with you.
Yeah, thank you so very much once again.
With that, it's time for us to head into a short break. But coming up, we bring you the story of Woo Television's a special conversation with the CEO, Devita Saraf, on the company's revenue picture, fundraising plans, and more. Stay tuned.
Welcome back. You're watching Startup Street. Now, a household name in the Indian television market, Voo Televisions recently launched its 98-inch television in association with Amazon. Now, speaking to my colleague Yash Jain, CEO Devita Saraf said that the company's focus will remain on profitability. She also spoke about finding the right investors for future investments. Take a look at that conversation.
And I saw that there was a sort of seismic shift happening. People in India are becoming more foreign return, more grown up on the internet, educated by Google. And I said, this is not the India that I've grown up in. This is not a socialist, we only want the cheapest product kind of India. This is a very fast, upwardly mobile India. And I said, you know what, why don't we have a global brand that is on the top of the pyramid? And so I work closely with the likes of Intel, Microsoft, etc., set up our own labs. And out of that was born Voo Televisions, which is focused on doing what we call luxury technology.
Globally and in India, as far as sales of televisions are concerned, how do you rank today? Where does it stand, both on a global level and in India?
So in India, for example, we are a 900 crore business, and 80% of my sales comes in the 50-inch and above category.
Okay.
So if you take as a market share, what happens is most people look at volume and they look at businesses like a 32-inch, which is the 60% of my competitors' products mix. For us, it's 6% of our product mix. So market share-wise, I will say we're very high and in the top 3 brands in 4K TVs and top brands for large-size TVs, QLED TVs. And our business has grown in a way very interestingly, where profitability has grown 3x in the past few years, because our focus not just on growing market share and putting numbers out there, but actually increasing the ASP, increasing our range in large sizes. And that has been the growth that we've gone after, as opposed to just blindly like customer acquisition. Be in what they call in Hindi, lambe race ka ghoda. Don't be unicorn, because unicorns, as we know, don't exist.
Correct. I think FY23 at the start, of course, you just reached the 1,000 crore mark in terms of revenue. Where do you stand now? And how do you plan to increase your revenue in terms of, Indian market as well as global market put together for the next 2 to 3 years? What's your outlook towards
So we've started doing business in the Middle East. During FIFA, we launched in Qatar, and I was there myself. And I think the markets in a lot of Middle East, etc., is very interesting. They look at India as a country where they want to bring the latest tech. So huge opportunity for us. But one thing I will say is I own 100% of this business, which is why they put me on those rich lists and all that you've mentioned. And as someone who is, as you said, the founder, CEO, investor, and owner, the first thing that I care for, I'll be very honest, is profitability. So the way we looked at our entire business today, whether it's the distribution partners we have, whether it's the product mix we have, whether it's the customer segmenting, is that our profitability has to grow, as opposed to a lot of people who've entered this industry and are willing to take a hit on price, but then they're not able to sustain their business or their customers.
Let's just understand this thing. What is the annual revenue that you make around? And what kind of profits do you derive out of it? And are you operationally as well as on the bottom line profitable on both aspects?
Yes, absolutely. We're profitable on all sides.
Would you mind sharing the numbers? Just a couple of...
Well, as I said, I've shared the revenue numbers in the product mix. We don't get too much in the semantics of what are gross margins and costs, because obviously our competition is very like watching CNBC, oh my God, Voo TV CEO is talking about their numbers, we need to follow this. But more than anything, it's a privately owned company.
Absolutely.
So we share our data very selectively. But I will say that I'm happy to share, of course the ROC filings are there online for anyone to see, that we have been profitable for over a decade now. And we've increased our profitability post-COVID with the strategic changes that we took.
Perfect. I'll give you that leeway. What I want to understand is another interesting aspect. It's a 100% owned company. So far, why haven't you felt the need to get an investor? And do you think that need will arise, considering the kind of growth that you're seeing, to get funds into the company? That need will arise sooner or later, let's say in the next 3 to 5 years. Do you see that happening?
I think we have a good cash flow for our own working capital needs. If an investor comes in, we want someone who understands that this is not a brand that we want to dilute to growth.
So no plans to get an
So
investor?
we have plans to get the right investor who thinks like us, who says, okay, Voo as a brand is focused on HNIs and Henrys. Henrys being high earner, not rich yet, the aspirational audience. And we want to grow the brand in India and abroad without diluting it as much as it's popular to do these days.
Okay, but
So
no
never
IPO
s-
for sure. I mean,
Listen,
you would prefer private investor over IPO. Is that?
you're like trying to make the decision for me. Like, you should do this or you should that. See, if you want to do an IPO, it depends on the market that you're in.
Correct.
But as I said, that we today are very, very loyal to our customers and what we build. I don't want to completely change what the brand is just because we brought on an investor. I can't do that to my team or my customers either.
What are the new product categories that you're seeing? Could we have a view on a wrist or, I mean, any other different product category on the consumer electronics side?
So the products that we're in, we do everything displays. So we have televisions for home, televisions for offices. We have video conferencing. We have specialized displays for cars, etc. So anything, that's what the company is called View. Anything that you see, any display, you're going to find a View product in it. There are certain categories like smartphones, watches and all. Apple's doing a good job. We're happy to be the Apple of TVs for now.
You alluded to, the whole culture of unicorns and valuations and all of that. What is your valuation right now? Just that, I mean, just reminds me of that. Any number that you can put to that?
Honestly, last year when they did that rich list, they put me personally at an 1,800 crore
That's
valuation.
your personal net worth.
Which was, it's 100% of
Correct.
the business, right, which I own. So that's the last published valuation report that we've seen, which would be basically on the PE ratio in any case.
Correct.
So that would, I would say, just because it's a published, authorized one,
You'd go with
and
that
I've
one.
seen for an 800 crore valuation for this business. There are people who will add any kind of multiples to it and make it much higher. But I will be honest, this is a very worthy company because of the way, especially in the next year, how we expect our profit to be.
Well, with that, it's a wrap up on this edition of Startup Street. More news and updates continue on CNBC TV18. Stay tuned.